And I'm here to share with you about market sentiments today. Today we're still going to be talking about the continued wanderings about the U.S. economy future. Many people are starting to doubt that if the U.S. will have a soft landing, as the Wall Street banks have expected in the earlier parts of the year. Recently, the U.S. stocks have been closing up for 2023. S&P 500 has closed up 16%. The Nasdaq was up nearly 31%. However, much of the strong rally has been driven by the AI boom, and the confidence in the overall economic level has been less since the beginning of the year. Banking industries are being the small barely sustaining the growth in the 2023, while the Dow Jones with big stock and low tech stocks have been risen well below the S&P 500 and Nasdaq at 4.44. The rally in the U.S. stock market is only for the tech giants in the chips and other AI-related industries. However, for most of the stocks, including the companies with less of the size, they have been closing low and recently, and their financial reports have shown losses overall for the companies in S&P 500. There are still cracks below the market surface, for the small capitalized stocks are not performing well, and it looks like top players are doing the worst, and the relative weakness behind it. Historically, small cap stocks lead the way during the recovery and sold off during the periods of economic pressure. However, given that they represent companies with most of their sales completed nationally, investors want to find clues about small cap stocks about the health of the economy. While confidence has increased that the Fed will make soft landing, there is far from agreement on the weak links in the market. Most companies that do not involve in this year's rally noted that S&P rebounded strongly from its October lows, but only 40% of the Russell 2000 stocks are above the 200-day moving average. By contrast, more than 90% of the Russell 2000 index above its 200-day moving average from 2020, she said. Many institutions and market participants, including Goldman Sachs, are optimistic about the outlook for the U.S. economy. However, the stock market is sniffing out something about the future, which is that the current data don't tell us. Remember that most of the data, like retail sales, inflation, etc., lag behind, with the interest rate reaching a 15-year high and student loan relief ending in a few weeks. It looks like consumers will no longer be able to power the economy as they will for much of these years. The BOA strategist led by Michael Hartnett said, called for defensive-minded customers to buy assets that have already rapidly declining in growth, such as regional banks and small-cap stocks. It says that investors should be loan on assets that have already put for a hard landing because they lose less from a potential recession, and if there is no recession, they'll have a lot of upside. Other strategists warned that investors should focus on post-cycle portfolio of defensive industrial energy and energy stocks, that the stock market has not yet reflected the risk of a recession. As a typical case in the period, the PE expansion has exceeded the fair value determined by the macro fundamentals, which puts burden on renewed growth and or incremental policy support. That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.